So, the government just expanded the first home guarantee scheme on October 1st, and on paper, it looks like great news for first-time buyers. They removed the income cap, opened it up to everyone, and increased price limits across every city. But here's the thing. When you make it easier for more people to buy property with less money down, you're not just helping buyers get into the market faster, you're also increasing demand, which pushes prices up, which then offsets a lot of the benefit the scheme was supposed to provide in the first place. And the data is already starting to show this. Let's get into the nitty-gritty. In a nutshell, the First Home Guarantee is a federal scheme that lets you buy property with just 5% deposit without paying lender's mortgage insurance, or LMI. Now, for those that don't know, lender's mortgage insurance, or LMI, is basically an insurance policy that protects the bank if you default on your loan. And it typically kicks in when your deposit is less than 20%. Depending on your purchase price, LMI can cost anywhere from 10 grand to 50 grand or more. Under this scheme, the government acts as a guarantor for the remaining 15% of your deposit. So instead of the bank seeing you as a high-risk borrower with only 5% down, they treat your loan as if you put the full 20%. Now, as I mentioned, they made some changes to the scheme at the start of October, and they're a pretty big deal. First, they removed the income cap entirely. Before this date, couples were capped at $200,000 combined income and singles at $125,000. If you earned $1 over that threshold, you no longer qualified for the scheme. That cap is now gone. Second, they removed all place limits. Previously, there were only 35,000 spots available each year. Now, every first-time buyer who meets the criteria can have access to it. Third, they've increased the property price threshold in every major capital city and regional area. I know what some of you are thinking. Steve, those price caps are still pretty limiting. And you're right, but here's the key. This isn't designed for you to buy the median home. It's designed to help you get into the market faster in suburbs that are still affordable but positioned for growth. Let's talk about what's actually happening with this scheme, because the government's data reveals something most people aren't discussing. As of June 2024, under the old rules, 84% of first home guarantee approvals went to households earning less than $150,000. Only 16% went to those earning between $150,000 and $200,000. And the median purchase price was just $561,000, which is well below the caps that were available even before this update. So what does this tell us? Most people using this scheme aren't pushing price limits. They're buying strategically in affordable areas. Let's look at the deposit savings data, because this is where it gets interesting. For a $600,000 property, you typically need around $120,000 saved for a 20% deposit. With this scheme, only $30,000. That's $90,000 difference in upfront capital, but it gets better. Without the scheme, you'd also pay around $22,000 in lender's mortgage insurance on a $570,000 loan. With this scheme, zero, donut. So in total, you're looking at saving around $112,000 in upfront costs on a $600,000 purchase. That's massive, especially when you consider how long it takes the average household to save that kind of money. Most of the time they're inhibited by their rental payments anyway. Here's another point people aren't talking about. 70% of applications under the old scheme were coming from couples, not singles. Now, why does that matter? Because two incomes typically mean faster deposit savings and stronger borrowing capacity, which means couples are disproportionately benefiting from this scheme. With the income cap removed, higher income couples who were previously locked out can now access it. Let's say you're a couple earning 220 grand combined. Before October 1st, you weren't eligible. Now, you're not. And with that income level, you can comfortably service a loan of $880,000 to $1 million, depending on your other debts and expenses. That means you can now buy at or near the price caps in Sydney, Melbourne, and Brisbane, which opens up significantly more suburbs and property types than before. But here's where it gets tricky, and this is something I see all the time with clients. Just because you can borrow up to $1 million doesn't mean that you should. The scheme removes LMI, but it doesn't change the fact that you're still going in with only 5% equity. If the market corrects even 5 to 10% in the first few years, you're immediately in a negative equity position. I'm not saying don't use the scheme. I'm saying that you need to be strategic about where you buy, what you buy, and how much buffer you have in your budget for rate rises or holding costs. Let me give you a real-world example. Let's say you use this scheme to buy a $900,000 property in Melbourne with a $45,000 deposit. Your loan is $855,000. At current interest rates of around 6.5%, your monthly repayments are roughly over $5,400. Over 30 years, you'll pay about $1.1 million in interest alone. Compare that to waiting another 2 years, saving up to a 10% deposit of $90,000 and buying the same property. Your loan is now $810,000 and your monthly repayments drop to $5,100. Over 30 years, you're about to save $100,000 in interest. But here's the counter argument. If property prices rise 5% per year for those 2 years, that $900,000 property is now worth $992,000. Your 10% deposit now needs to be $99,000, not $90,000. And you've also paid 2 years of rent, which say at $2,500 per month is another $60,000 gone. So which is better? It depends entirely on your situation, your risk tolerance, and where you're buying. That's why I always tell my clients property investment is based primarily on the numbers, but you also need to factor in your personal circumstances and goals. Let's talk about who actually benefits from this scheme. Because despite the expanded access, there are still significant restrictions that lock out a large portion of potential buyers. First, you must be a first-time buyer or provide proof that you've not owned or held interest in a property in Australia in the last 10 years. Second, you must live in the property as your primary residence for as long as the loan has a guarantee under the scheme. Third, the property must meet certain standards. It must be a house, townhouse, or apartment. It can't be a vacant land purchase. And in some cases, lenders have additional restrictions around apartment size, building type, and location. I've seen clients get pre-approved for the scheme only to find out the specific property they want to buy doesn't actually meet the lender's criteria. And fourth, you still need to meet the bank's serviceability requirements. The scheme removes LMI, but it doesn't change how much you can borrow. If your income, debts, and expenses don't support a loan for the size that you need, you're not going to get approved regardless of the scheme. Here's a real-world scenario I see all the time. A couple earning $180,000 combined thinks they can borrow $900,000 because they meet the income threshold. But they have $50,000 in personal loans and credit card debt. And they're spending $3,000 a month on discretionary expenses. So when the banks run their serviceability, they can only borrow $650,000. The scheme didn't change their borrowing capacity. It just removed the LMI cost. Now, let's talk about the flip side. Who really wins here? High-income first-time buyers who were previously locked out. If you're a couple earning $250,000 with minimal debt and strong savings discipline, you can now access this scheme, buy at the upper price limits, and get into the market significantly faster. Dual-income households with stable employment, banks love two incomes because it reduces risk. If one person loses their job, the other can still service the loan. This is why 70% of the scheme users were couples. The other people who win are people who are willing to buy in growth corridors rather than established blue chip suburbs. If you're flexible in location and you're willing to buy in areas 30 to 40 kilometers from the CBD that are still under the price caps, you can get significantly more property for your money. All right, so if you're planning to use this scheme, here are the 3 strategic moves you need to make right now. Move number 1. Get pre-approved with multiple lenders, not just one. Different banks have different criteria for this scheme. Some are more conservative with apartments, some have stricter serviceability tests, and some have better interest rates. I've had clients get declined by one lender and approved by another for the exact same loan amount. Don't put all your eggs in one basket. Move number 2, reverse engineer your borrowing capacity before you start looking at properties. Here's how. Take your gross annual income, multiply it by 5 to 6 times depending on the lender, then subtract your existing debts. That gives you a rough estimate of your maximum borrowing capacity. Then subtract the 5% for your deposit. That's your realistic purchase price range. For example, if you earn $150,000 combined, your borrowing capacity is roughly $750,000 to $900,000 depending on debts. With a 5% deposit, you're looking at properties in the $789,000 to $947,000 range. But remember, just because you can borrow that much doesn't mean that you should. Move number 3, focus on cash flow positive or cash flow neutral suburbs. What do I mean by that? You want to buy in areas where if you would have to move out, the rent would cover your mortgage repayments. This gives you the flexibility down the track if your circumstances change. For example, if your mortgage repayments are $5,000 per month, you want to buy in a suburb where similar properties are renting for $4,500 to $5,500 per month. Here's the thing most first-time buyers get wrong. They buy based on where they want to live right now, not where the property will perform over the next 10 to 20 years. And that's a costly mistake because your first property is rarely your forever home. You're going to upgrade eventually. And when you do, you want that first property to either be positively geared or at least not costing you money every month. The first home guarantee update is one of the most significant shifts in housing policy we've seen in years. But like any opportunity, it's only valuable if you know how to use it strategically. If you're serious about buying your first property in the next 12 months and you want to make sure you're doing it right, I've put together a completely free residential property course that walks you through every step of the process. We cover how to assess suburbs, how to calculate your borrowing capacity, how to negotiate with agents, how to structure your loans, and how to avoid costly mistakes you make as a first-time buyer. It's the same framework I use with my buyer's agency clients, and it's completely free. The link is in the description below. I release new property analysis videos every week, breaking down the market trends, policy changes, and investment strategies that actually work. Thanks for watching, guys, and I'll see you in the next one.